Hey Pepperstone traders, this is Boris with BK Forex. Welcome to our first of weekly technicals. I'm so happy to be with you and take a look at the charts this week. It's been, needless to say, an unbelievably tough week if you've been a dollar bull. Huge amount of technical damage. And I think I'm going to start this week. Usually I start with euro dollar, but I think we're going to start this week with dollar yen just because there's been so much damage in that pair over the last 4 or 5 days. Undid pretty much all of the bull move that we've had since the beginning of May. That it's really worthwhile taking a look at here and see where we stand at this point. So of course, if you're watching this, you know at this point that non-farm payrolls were horrid, came in much weaker than expected, around 38,000. That's considerably weaker than people thought at about 178. It's really really hard to determine. I mean, the bearish case, if you sort of take a look at the technicals and you marry it with the uber bearish fundamental view that we are on the tip of a recession, that this is the tipping point of non-farm payrolls possibly even going negative as the U.S. economy begins to contract suddenly, then yes, I think this chart just simply will scream continuation. On the other hand, from a fundamental point of view, I kind of want to point you out to 2012 when we had the same kind of a dip in non-farm payrolls. There was a very big slowdown and then a rebound back up. So I think technically here it's obviously going to follow the script of what we see over the next 6 to 8 weeks. And most importantly, I think is really what's going to happen in July. If we don't get a bounce back in July, certainly a lot of these charts are going to see much further breakdown, and we're coming up to some absolutely critical technical levels that are going to be very important to watch ahead of all of this development. Looking at this on a longer term basis, there's just little to want to get you excited about the long side, except perhaps just the stubborn contrarian point of view and the belief that this potentially could be a double bottom. Because if you look at the chart on a longer term basis, you see nothing but a series of lower highs. I mean, this is very negative technically for the pair, and essentially the correct trade in dollar yen consistently throughout this trend, if you sort of look at this longer term trend, has been just to simply sell any of the bounces that come up in the play. The only thing I will say that could give me, as a dollar bull, for example, a lot more confidence is if we can stop the decline somewhere around the 106s. The low over here, let me just, I'll bring my display chart here, and I think the low over here was what, 105.54, right? That's the near-term low. If we can stop in front of the 155.54 and then bounce back, we will effectively create one of my favorite technical setups, which is a higher double bottom. A higher double bottom generally is a very powerful turn pattern, meaning that you have a much higher probability that the true turn back to the upside is starting to happen. If we break the 105.50, that is going to create just almost terminal damage. At that point, really, every single rally becomes a sell because dollar yen is just looks to be then a full unwind, perhaps all the way down to the parity level, and that certainly is going to create massive amount of long-term liquidation out of the pair. Let's take a look at the. Let me just go to the longer-term charts just for us to kind of see where we're at. The reason why I talk about the parity, let me just see, I think probably maybe we'll take a 3-year chart. Yeah, I don't even have to need a 3-year chart, but let's just take a look at this level over here. The reason why this 105 is so critical is when you look at the yen over a longer term period of time, the yen basically, the rally in the yen and the decline in the yen really can be viewed in 500 or 5 yen increments up and down. So we take the 105s, then we break into the 110s, there's a little bit of retrace, then we take the 110s into 115s, we kind of pause, then the 120 becomes a pause, and ultimately the 125 becomes a sort of a double top decline. We come back down to 120 as support. We do huge amount of damage here. We take out the 115s and really can't even stop at the 110s. We stop a little bit ahead of the 110s for a while. This is all weekly charts. Then break down to the 110s, and then of course come back down here to this much longer support point from 2014, that is the 105 point. So are we making a full U-turn over here? Very likely. If we don't, this is the key thing though. To me, the key thing to watch this week is just how much fury can the shorts bring to this. Can they bring it all the way down below the 105? If they do, then I think the power lies with the shorts, and then every single bounce is a short. If the shorts just throw everything but the kitchen sink at dollar yen, and we can hold the 105.50, even if we can just simply hold the 105, but a 105.50 would be even better, and we start to kind of move back up, that in itself would be, I think, a very positive development, and we can revisit it next week and see where we stand. So the yen story right now really is all going to be focused around this 105 level for the short side. The long side, it's whatever squeeze you can get. The more immediate squeeze. I think let's go back to the daily charts just to take a look at where the 108 becomes now the most immediate sell point. In other words, if we bounce back, it's going to find resistance at the 108 level as the primary level. So it's really a very, very thin ray of hope for dollar yen bulls, but it's still, I think, an interesting point of hope. And my point is, I guess, that if you are getting uber bearish at this point and just want to short everything in dollar yen, I caution you that you could run into major, massive support at this 105 level and get squeezed back up towards the 108s. So I'll be watching that very carefully. Having said this, though, the trend clearly to the downside, and if we get a bounce back up towards the 107.50, 108, it's going to be a relatively high confidence trade to want to short it over here for nothing else than just to simply revisit of the 107s, 106s. For yen to do the full drop down and then a full V-shaped recovery back up would require, I think, a significant surprise on the fundamental side. In other words, something to the effect of where Janet Yellen, which she's going to talk about on Monday, we'll see what she says, literally says, we don't care how bad the U.S. data is, we are going to hike. In other words, where she is incredibly definitive in her hike, that I think will unwind a lot of the shorts. But that kind of a statement from Janet Yellen on Monday is going to be very, very unlikely. So overall, the way we're looking at dollar yen here is any kind of a rally towards the 108 is probably going to be a short. We're going to be watching carefully. I don't want to short this thing into the double bottom. I want to see if it can hold. And actually, more importantly, if it can hold a higher double bottom here, we'll take a small punt and try to see if we can trade contrarian to the long side, assuming that dollar yen is kind of bottomed out here for a near-term bounce. So trade is very interesting. Definitely a lot of jockeying back and forth in this position, and we'll be watching it both ways. Now, let's take a look at euro dollar and see what's going on over there. So euro to me is another very interesting trade. This is obviously just a huge squeeze up. Anybody who is short euros here into the 111s got their head handed to them. And by the way, this is a good example of why so dangerous to short into supports. Look at where we're at. We were basically 111, 111.50, 110.50 was the key support in the euro dollar. This whole support zone over here from earlier in the year around March, right? We came in here. We didn't really break the 10.50s, right? We didn't even break the 111s in any significant fashion, and we held it. We held it for 3 or 4 days. And the fact that we held it, this is a sort of a modest version of a higher double bottom, right? Where this is a low that is lower than the low over here. Just a small speck on this side ahead of the non-farm payrolls would have paid off big if you'd gone the contrarian way. So that's why I'm very, very leery of shorting into major support areas, and that's why I caution you about the dollar yen position for right now. It's only if the 105s get broken that you probably can begin to start selling any kind of a lame bounce off the dollar yen. But as far as the euro dollar goes, the key thing to me here is that we're now going the opposite way. We're now coming up into very decent resistance into this 1300, 1450 level. Remember, the euro dollar did just a flame out turn at the 1600 level. And I think even if it kind of barrels its way through this 13, 1450 level on further dollar bearishness, it's going to have a much, much harder time coming up against this. That's for a lot of reasons. We don't have really good fundamentals out of Europe. We don't have any kind of a tightening monetary policy. Draghi himself said that if things begin to slow down, he has absolutely no compunction at driving rates even further lower and doing more accommodation. So the focus of European monetary policy is still highly divergent from the U.S. monetary policy, and that's why I think it's going to be very, very hard for euro to clear this 1600 level, not just because of fundamentals, but of course because the technicals here are just showing a big flame out candle here. This is a shooting star candle that tends to be a very, very good turn signal for everyone to look at. Taking a look at the longer term charts here, again, let's just see how the weeklies look, because I think we're basically looking at this 115 area, several spikes out of it, but we are unable to clear it. Now, I will say one thing that is kind of interesting here. If we do break the 115 and hold it, this is the critical thing. If we hold above the 115, the whole tenor of your dollar chart is going to change completely. And that is going to look much more bullish for the euro dollar, because on a longer term basis, what you will have seen is a massive bottoming out formation with a series, by the way, of higher lows over here, which is very positive on a trend line basis. And if we can just close above this level on a weekly basis, this is a weekly chart, that will send a very strong signal that the euro may want to go all the way up to the 120s. Until that happens, it's pretty much short against the 115. And I think at this point, that's probably going to be the safer bet. Let's take a look at the pound, which has been very, very volatile because, of course, of Brexit and everything else that's going on. Let's take a look at a 6-month chart here of the pound. Give it a second. So, of course, the pound has had sort of the weakest reaction against the dollar. It just had a very tepid rise on Friday. And that's because there's much greater concerns against the pound. We have the Brexit vote coming up, and that Brexit vote is just weighing very, very heavy against cable. On the most obvious front here, the 47s, the 147, is the big resist area for cable. It's essentially a triple top at this point. And against, this is pretty much the resistance point against which it trades. The bottom, the lower end of the range here, is essentially 43 and then followed by 41, and ultimately not even by 40, but really the 139s, the sort of pre-Brexit hysteria. This is when everybody thought that Brexit was really going to be a huge possibility. The thing that's very difficult about making any kind of technical analysis of this particular structure is that it really doesn't matter. If we have Brexit voting yes. In other words, if the leave vote wins, the volatility that could ensue is utterly unpredictable, and all of these levels could certainly go. Now, if you're trading it technically against the Brexit leave vote, you could say, I could try to make a bid 41 as my first level of support. I could try to make my bid at 39 to see if it holds. But there are some people who are actually projecting, some analysts projecting that we could have a 9-10% decline in cable. We really could take out 135s. If you look at a longer term basis, and let's just take a look at the weeklies. Oops. So this is 6 months. I'm just trying to pull the data. We're having a. I'm just actually going to see if I can do monthlies because the weekly data seems to be having a hard time. So the monthlies, yes, I mean the monthlies really scream 140 as the key support, and I suppose, if Brexit happens, the 140 could be a way for you to kind of trade the bounce off this thing, but I wouldn't do it because I think if it does happen, it's going to slice through that, and realistically, it could come down all the way. Let's see if we can go on the monthlies even further back, maybe 5 years. Yeah, there really is nothing. There's just nothing here, even 5 years back, that supports the 140. We might have to go. Let's just go back a little bit further, maybe even 10 years. Yeah, 35s, right? So, first of all, trading this into the Brexit, you have to trade very small, and you have to just give yourself this 145, 135 support area. 35, I think, is probably going to be a very reasonable place to try to scoop up cable in case of a massive panic sell-off. Now, to the upside, if Brexit sort of goes away and the Remain vote wins, the clear, most immediate trade, it's a very asymmetrical trade because, in other words, the upside, I think, is going to be much more limited. The downside is much more severe. So if you look at the upside on the dailies here, if you look at the 60s, clearly the 47 is the first penetration. And then, of course, I think the 49.50. Now, the 49 is the near-term resistance that's on the charts. The 50s is the more psychological level against which maybe people want to push cable on a euphoric, pro cable move. So we're in a state of suspended animation for the next 2 weeks as we wait for the actual big event to happen. There's a modicum of small economic data on the front, and honestly, I think none of it is really going to matter a lot. You could trade around the edges trying to pick up the 43 bottoms here, maybe pick up the 41 bottoms if we get a much more negative move. You could try to fade the 47s, but all of this I think is just going to be futile in many ways because so much of the positioning and counter positioning is really not going to be driven by anything but this massive overhang event. And from a technical point of view, really, I think the most immediate points that all of us are going to be looking for the next couple of weeks is the 150, 149, 150 to the upside as a small squeeze to the upside on a positive move, and the bargain hunt buy at 135, which is a multi-decade, one decade long, multi-month low at around 135 as a possible scoop. And generally, in this kind of environment, I would never be looking to buy at one single price. You sort of have to pick a barrier and buy 37, start buying 38s, start buying 36s, start buying 35s, because you never know exactly where the bottom is going to be in that kind of a fast and furious dealing. So I think cable is very interesting, but it's one chart that I would set aside for the next 2 weeks and simply watch after the Brexit event, because there's really very little meaningful data, given the fact that we have this huge overarching event that could completely wreck whatever charts are telling us as far as support and resistance goes. Now, as far as economic data goes, this week, the big economic data actually happens in the commodity dollar currencies. And of course, we have the RBA decision, the RBNZ decision, and the Canadian employment data. And that's really where some of the more interesting economic data-driven price action could be relative against the technical formations that we're seeing. So Aussie looking very strong. This was a nice big breakout on Friday post. We ended up on the highs. It's as we open up Monday morning in Australia, it's very probable they're going to want to try to drive this through the 74s because the momentum here is quite strong, and we should have Asia follow through on a negative dollar move. A lot of it will depend, of course, on what Ms. Yellen says on Monday. If she sounds like everybody else saying, we're going to be really cautious. This was a number that caught us off guard. We don't think that the economy is strong enough. If she gives any kind of a dovish signal on Monday, no doubt in my mind that Aussie is going to break through the 74s and could even go close to 75s. Because then what happens, it's actually quite interesting, is that if we get dovish Janet Yellen, and then we have the RBA decision, which comes in, it's Tuesday our time, so I guess it's Tuesday Australia time too. That double whammy of dovish U.S. decision and the RBA holding still will create massive amount of carry trade flows that could push the Aussie right into the 75. Now, 75 is a major resist area, and here, for those of you who are looking to fade the move, you may want to consider trying to fade the move here, because classic technical formations here, former support becomes present resistance. This was support 1, 2, 3, 4 times before it finally broke. So I think it's going to be pretty significant resistance here on a super uber positive Australian, uber negative US dollar movement into the week. So I think very much worth watching. This is going to be one of the stellar marquee trades at the beginning of the week. Watching the 74s, of course, and the first thing Monday morning to you guys, Sunday morning to us. And then furthermore, Monday development to us, which I guess will be Tuesday to you as far as what Ms. Yellen says, and then what the RBA does after that. All of that can really move the market here towards the very key technical levels of the 75s, the upside. Now, the negative side, if we unwind all this, if she's super hawkish and the RBA is super dovish, and they say, hey, we're thinking of cutting rates for whatever reason. Of course, the break here, that I think the real technical damage that could happen if we, this is a big surprise, I don't think anybody's expecting this, is if we unwind this whole move and break below the 72s, that would create a massively negative signal technically, because that would be a bearish engulfing, meaning that all of this upward move would be completely retraced negatively to the downside, and that would signal much lower potential towards the $70 level. Probability of that right now, I have no idea, but just guessing, I think the probability is 10%. In other words, I think it's unlikely that scenario could unwind, but you never know. This is why we trade technicals. We look at what the charts are telling us, not what we think is going to happen. We wait till the events happen, and then we trade off of that. So if we do get a massive unwind and a bearish engulfing, and we break below the 72s, I think at that point, of course, Aussie becomes a sell the rally trade continuously, and you could confidently target possibly the 70 zone, which is the next support level in the Aussie dollar. The next trade that I want to look at is actually the CAD, dollar CAD, which has also shown a modicum of strength here. Oil trading at 50 definitely has helped it, but here's the thing: the Canadian data has not been great. We have the Canadian employment coming up on Friday, full week ahead. And I think it might be a disappointment. In other words, the negative move in dollar CAD. Dollar CAD is traded, of course, inversely, so that means Canadian dollar weakens as dollar CAD rises. It found serious resistance here at, what a surprise, the former resistance points at around 132, right? This 132, 133 zone really found almost a double top resistance. And this is one of the reasons why it's so great to look at technicals, because we can really anticipate with high degree of confidence where there's going to be areas of supply and where there's going to be areas of demand, and make intelligent trades off of those areas based upon what's going on in the marketplace. So 32, 33 zone definitely found a lot of resistance because of the former resistance over here. Now we're coming back down. Now, ironically enough, in the olden days, we thought that 130 was the support area in dollar CAD. It is not. The real support area is actually the 128, 127s. This area over here. This is an area that was big support event until we just the full capitulation move was down to the 125s. But once the capitulation move sort of happened, the near-term support here is going to be the 127s. So I think if dollar CAD comes into sort of like the 127s ahead of the Canadian data, and it doesn't really penetrate it to the downside, and the data out of Canada is going to be weak, that's probably going to be an interesting buy point. Somewhere around here is going to be an interesting buy point for dollar Canada going the other way. So I'm not nearly as bullish dollar Canada as I am Australian dollar on just a techno-fundamental basis. Now, Kiwi, which is my last look of all the majors. And by the way, just sort of to give you guys heads up, I really don't look at dollar Swiss. And some of you may look at dollar Swiss, but it's a very, very tough pair to trade because of all the SMB. Because first of all the brokers have all sorts of margin requirements against it because of what SMB is doing, and because frankly, it's just a very, very small and uninteresting pair to trade in many ways. I'll be happy to look at the charts if you guys really want me to. Write me, let me know. But I really want to focus on the 6 majors for the beginning, and then in the weeks following we'll take a look at the crosses and some of the other stuff that we can cover. But right now I sort of wanted to just lay down the foundation of where the major technicals are lying, because that's going to be the big stories this week, especially as I said in the commodity dollars, where a lot of the fundamental news is developing. And nothing is, of course, more obvious for us than this 70-50 area. So RBNZ stays stationary, doesn't raise rates, uber bullish Kiwi. We're coming up against here. This is going to be where the rubber hits the road. This is going to be where the bulls and the bears really make their final stance. If we can't break above this on a closing basis, the way I would look at this is RBNZ makes a statement. We have obviously the knee-jerk reaction. I would let the day trading happen. I would actually let the daily candle complete itself. And if the daily candle cannot hold the 70-50 level, in other words, cannot close above this, then you could feel pretty confident that this is a triple top and begin shorting it, despite the fact that it's a positive news, so on and so forth, because it would suggest to you that whatever positive news there is, the market feels this is a fully valued proposition at this point. A shock to the system. A shock to the system is the RBNZ cutting rates, which is not impossible. I don't think it's, data has been relatively decent. Dairy prices have been pretty good, but it's not impossible for them to consider it, because they don't like to see the Kiwi this high. They want to see it lower. They like to see it at 65. So they may want to take the advantage of this and kind of kneecap the bulls while they have them. So if the RBNZ cuts rates here, the break, this is the interesting thing to watch here the other way, will be the whole 60, well, let's just say 66.50. It's really, that's the much more important support area here, the 66.50. 67 has been a relatively decent support area. It's sort of, you can see it's very chunky here for pretty much most of the year this year. But it's sort of the 66.50. How far down do we come down? Because even if they cut rates, I wonder if the bulls are still going to come in on the assumption that RBNZ is not going to cut anytime for a long time, and it's still going to be a relatively decent carry trade going forward. So support, if we find support ahead of the 6650s, it's probably going to be actually an interesting buy in the Kiwi. If the Kiwi fails above the 70.50, meaning fails to hold and close above the 70.50, it's probably going to be an interesting sell off of the RBNZ announcement. In between, everything is just range bound, and you could we'll make a decision on that depending on how the price action reacts itself off of the news. But generally, clearly, the really big areas to watch here is going to be the 70.50 as a triple top, how well it can penetrate that, and of course the 66.50 as a long-term support area in the Kiwi that may hold on a surprise cut if we get that. So that's how the week shapes up. It's really going to be very interesting. And I said it's going to be really a commodity dollar week for most of us as far as the key levels to look at. With Aussie, of course, the 75 is the key level. Kiwi, as I'm showing right now, at the 70.50 level, and the 66.50 to the downside. Dollar CAD, this 127.50 zone to the downside. And the most important, I think, let's come back to our original chart, which is, I think, really the story next week. Does dollar yen hold the lows? This is going to be a very, very big story. This is going to be the dollar either just capitulates, and if we break the 105s, we are then on trend to go towards the 100s. And then essentially at that point, if we break the 105s, every rally in dollar yen becomes a sell all the way up to like 110 level, right? On the other hand, if we can hold it here for 2 or 3 days, it's probably going to be a very low risk but intelligent buy, because we would have a higher low and potentially a regrouping of the dollar move. So I wish you guys best of luck, best of trading. Email me if you want at contact@bkforex.com with any questions you may have, any suggestions you may have. And as I said, love doing this with you guys, and we're going to keep on doing it with Pepperstone traders. All the best. Boris Schlossberg, over and out.